Happy holidays. I'm Sarah Burns with the Salt Lake Local Real Estate Group, coming to you today to give you yet another update on the 2021 housing market. Today is December 6, 2020. Since March of 2020, there's been a surge in housing prices. Now, this is driven by two things. It's driven by historically low interest rates and inventory rates, as well as mass amounts of buyers moving to the suburbs seeking larger homes. And of course, this is a result of unprecedented changes in our labor markets, wherein people are being allowed to work from home and anticipate that that will continue. But there's a little bit more to today's housing market. And to understand that, we need to look at the 2008-2009 recession. But before we talk about that, let's take a look at the increase in prices from 2019 to today. The median priced home in 2019 was priced approximately at $350K. Today, it's priced at $385,000. That's a 10.2% increase. Now, nationally, prices have jumped about 11%. If we're looking at the average price of a home, in 2019, the average price was $396,000. Today, it's $452,000. That's a 14.3% increase. We are 39% more deficient on inventory than we were in 2019, and we've got historically low interest rates at 2.8%. Now, looking at the 2008-2009 recession and the factors prior to that, we had mass inventory levels. We had the flipping of homes and land. Okay, so small investors would purchase properties, they'd renovate those properties, and they capitalize on them. Okay, same thing with developers, builders, and their investors. They would purchase land, and sometimes without bringing any value to that land, they would flip the property. Now, that drove up prices for the end user. Okay, in addition to mass product and the flipping of properties, we also had considerable lending problems back then. We had people with very, very low credit, and they were lended to as if they were A and B borrowers. Okay, so these things led to the recession of 2008-2009. But what happened in that recession? How did we deal with that recession? What occurred was incredible opportunities were opened for what we call portfolio investors. Okay, so these are publicly traded companies like Greystar and Alliance, to give you a feel for the kind of inventory and capacity a company like Greystar carries. If you go to their website, you'll see that they tout owning 693,000 unit, 2,500 companies, 28 billion in assets, 17.5 billion in sponsorships. They deal with existing and new construction in global markets. Okay, so the 2008-2009 recession opened up an opportunity for those portfolio builders. The other thing that happened is that builders and their investors went bankrupt. Okay, so they stopped building altogether. That took more inventory off the market. We also had historically low interest rates. And what people did is they refinanced their home. They weren't investing in new homes or existing homes. They simply refinanced their properties. All of this resulted in a serious deficiency of inventory. And once you hit bottom, there's only one place to go, up. Okay, so how is the market of today, of 2020, aligned with the pre-recession and recession of 2008 and 2009? You're probably saying to yourself, Sarah, what are you talking about? It's not. We had mass inventory at that time, and now we're seriously deficient on inventory, as much as 50%, depending upon where you're looking at in the nation. Okay, here's why it's aligned. When we're talking about the health of the greater economy and the housing economy, it's not just a matter of inventory, mass inventory or low inventory. It's a matter of whether the housing inventory prices are sustainable in the face of greater inflation in goods and services. Okay, so that's how it's aligned. So let's look at the flipping that was going on in pre-recession 2008 and 2009. The flipping of properties with small investors and builders and developers, that has now been taken over by these publicly traded portfolio companies like Greystar and Alliance. And the implications of this are huge, okay, because they're publicly traded. And so, you can take an entire community that's a rental property and you sell that to a new investor, and that drives up the rental property prices further. And that also trickles down into the housing purchase economy. Okay, so let's look at lending. Probably say to yourself, well, yeah, but we don't have the kind of lending we are. We're not taking C borrowers or lower and lending to them as if they're A and B borrowers. You're correct. We're not doing that. Okay, but what we are doing is this: the debt to income ratio over the decades continues to rise. Initially, decades ago, okay, it was at 20%, meaning that your housing was not intended to be more than 20% of your income. As we've had housing inflation, the maximum debt to income on housing that a borrower can carry has been substantially increased. So we have people that are paying in the 40s and 50% of their income to housing. In speaking with my lending partner, Ashley Seipert of Guild Lending, she's informed me that FHA borrowers that have no more than 3.5% down may be carrying 56% of their income on housing. Okay, that's a huge percentage. When you look at urban studies and sustainability, the data reflects that the more of your money you have allocated towards housing and the less down payment, the higher likelihood there is of foreclosure. Okay, let's also consider we've got a lot of homes right now, a lot of borrowers that are paying well above the appraisal price of the home. Okay, no, they're bringing cash to their properties. And you may be saying to yourself, well, who cares? They're not getting inflated loans, so no big deal. They're bringing cash. But let me tell you how that affects the greater market in the long run. First off, borrower savings are being minimized because some borrowers are paying 10, 20, 30, even upwards of $50,000 over appraisal price on their homes. So savings is substantially minimized. Okay, the other thing is that when that seller goes to resell that property, they're not just going to dismiss that amount of money that they put down on cash towards the home. They're going to want it back. Okay, so that also results in inflating housing prices over the years. The other way it affects us is that it lowers that borrower's equity. That $30,000 that they're paying over appraisal, that could go into their equity for greater sustainability. That's not actually happening, okay? The third thing that's really interesting that's going on right now is something called appraisal waivers. Now, in speaking with Ashley is only seeing appraisal waivers on refinances, and I believe that she said she sees a few of them on cash out refinances, but she's not seeing any of them in the greater purchase market. In speaking with a couple of other lenders, those lenders are reporting somewhere between 20 and 25% of their loans getting appraisal waivers. Now, what appraisal waivers do is they assign the value of a home strictly by looking at data. It's much like Zillow, okay, where the system doing it, it's an AI system, and it has no eyes, okay? It can't see if the comparable properties have been fully gutted and remodeled, or how functional the lot is, or if it's an east-facing lot with a spectacular mountain view. These things make a big difference in the true value of a home. So when you have appraisal waivers, you have values that are being arbitrarily assigned. Now, Ashley feels like this is not a big problem in the lending market yet, but she does say this is certainly something to keep an eye on. So going back to how these things are the same, I'm going to liken it to a quarter or to a dollar bill. both have got two faces. They've got two sides, but it's still a quarter. It's still a dollar bill. And this is how I would liken the different market shifts, or the health of different economies. Okay, it's not a matter, once more, of what your inventory levels is. It's a matter of whether the price of housing is sustainable in the face of greater inflation in goods and services. So let's consider a few other points that we experienced prior to the 2008-2009 recession. But first, I want to say that the National Association of Realtors and the Utah Association of Realtors, the data for both is reflecting that there will be some kind of an adjustment next year in housing prices. Let's talk about the housing moratorium. The housing moratorium ends on December 31st. Okay, so you've got renters with deferred payments. All that rent will become due for those renters. You've got a lot of homeowners who have taken advantage of that housing moratorium. With a lot of those lenders, those deferred payments, they're also going to become due. And then we've got local business owners, okay? Local business owners that are currently struggling with their overhead and their commercial building payments. So maybe you say to yourself, well, but this doesn't affect me because I'm not a renter. I didn't take advantage of of deferring any of my payments on my mortgage. My income's okay, and I'm not a local business owner. It still affects us. It affects all of us. And here's why. The economy is incredibly connected on a national and global level. All income levels, we are very much connected to one another in ways that we can't always see until we're moving downstream. Okay, so if a renter can't make their payment and the owner landlord therefore can't make the payment to the bank, then the bank's in trouble. Okay, so we've got this taking place in both the residential and the commercial markets. This will result in less tax dollars being collected on a state and federal level. Nationally speaking, local business accounts for about 25% of tax dollars. So that's, it can really affect economy. We've also got deflation in interest rates, and we have inflation in the cost of goods and services. We spoke about that in our last forecast. You can get more information if you look up, I believe we've called it the Salt Lake Local 2021 Housing Forecast. Of the people who have returned to work, Pew is estimating that 60% of those people are making less. Okay, so we have savings, that's dwindling, credit card debt, which is rising, something else that we saw prior to the 2008-2009 recession. And lastly, this is something that's really interesting, AI, okay, robotics. There's a really interesting article that if you Google Amazon relative to robotics, you'll be able to read on this. Since the pandemic of 2019, a lot of those jobs are being filled by robotics. And of course, it's not only with Amazon, it's with lots and lots of companies. Okay, so all these factors play in the health of our economy long term. Many economists are forecasting some kind of shift. My feeling, kind of looking at things, is that we might not see that in the first quarter of 2021. People are incredibly resilient. They have the capacity to carry burden for a long time before they give. So it may be the second or the third quarter before we start to see those shifts. But going back to resilience, it's very important to look at shifts in economies as just something that's restoring greater balance to the market. There's all kinds of really great things that happen in that shift. And one of those things on a deeper personal level is that we become more self-reflective. Our value systems change. We become increasingly fearless, increasingly creative and innovative. And those things breed wonderful relationships. It's very important that we remember how deeply connected we are, and the awareness and the care that we have for one another in all capacities is what determines ultimately whether our economy is sustainable, whether our own lives are sustainable. So in that vein, I'm going to leave you here. Ashley and I, over the next couple of weeks, hopefully, are going to do another video. We want to talk to you about creating deeper sustainability and happiness in your lives. We look forward to speaking with you then. Thank you so very much for joining us.